Today, I bring you a nanocap stock selling for just $3.7 million, and it has revenues of $21 million, and it's also selling at just 5 times FY 2023 earnings of 720,000. It's also selling significantly below book value and even Ben Graham net. The company I'm talking about is Universal Security Instruments, and it was founded in 1969. The company designs and markets a variety of popularly priced safety products consisting primarily of smoke alarms, carbon monoxide alarms, and other related products. Most of their products require minimal installation and are designed for easy installation by the consumer without any professional assistance, and they're sold through retail stores. They also market products to the electrical distribution trade through a wholly owned subsidiary, USI Electric. The electrical distribution trade includes electric and lighting distributors, as well as manufactured housing companies. According to their latest quarterly report, the company acquires all of its smoke alarms it sells from Aston Company, who are based in China, and had 3 customers that represented 18.6%, 10.7%, and 10.1% of sales. Now, this suggests the company does have some concentration risk, as if one of their customers doesn't return or if their supplier hikes prices, it's likely the company sees a hit to earnings. However, I would suggest this is an unlikely possibility, as neither of those possibilities are actually on the table at the moment. Looking at the balance sheet, we can see the company has very little longer term assets or liabilities. This suggests the company is very liquid, which is a strong trait, especially in this nanocap section of the market. The company has a 2.5 to 1 current ratio, again suggesting strong liquidity. Book value is sitting at 5.4 million, 45% higher than the current market cap. The book value alone tells me there is strong upside in the stock, as the majority of assets are current, and therefore the stock should at a minimum be hovering around that book value of $5.4 million. Using Ben Graham's net formula, the company is worth at least $5.3 million. Ben Graham stocks were usually bad businesses that were failing and losing money, but Universal Security Instruments is actually a strong business with solid profits and growing revenue. This suggests the stock should be worth book value plus a premium on future profits. I would conservatively estimate the intrinsic value of the company to be between $7 and $10 million, which is a 2 to 3x from current prices. Enterprise value is $4.7 million, which also makes it a very attractive takeover target. Moving on to the income statement, we see trailing 12-month revenues of $21 million, which is lower than FY 2023's revenue of $22.18 million. Now, this slight decline in revenues is due to the timing of orders and delays in both manufacturing due to supply chain disruptions and to delays in shipping and handling of containers at California ports of entry. While delays in manufacturing and shipping has somewhat improved over the past fiscal year, the company continues to experience significant delays in receiving inventory for sale. Now, these are temporary issues unrelated to the management of the company, and therefore I do not consider it to be a long-term trend, and rather I see it as a small blip for the company. Now, the company's revenue has grown at 7% per year from 2017 to 2023, and I expect that to continue after these short-term issues are resolved. As a result of this slight manufacturing blip, net income fell from $720,000 to $365,000. I expect net income to return back to the $700,000 range once issues around manufacturing have subsided. The PE ratio will likely rise to 15 to 20 at that point, which would give a market cap of between $10.5 to $14 million. That is a 2.8 to 3.8x return from here. One other thing I want to mention is the cost of goods is fairly constant relative to revenue, and the operating expenses is fairly fixed in place, meaning as soon as revenue picks up, it falls straight through to the bottom line without having to worry about increased operating costs. All of this while being a net Graham stock tells me that this stock has a lot of room to run from current prices. This is of a very simple and easy to understand business, and it jumps out to me as a stock Warren Buffett might have bought back in the 1960s. It has very little debt and it's getting smaller. The stock is selling well below book value and net with growing revenues and consistent earnings. I hope you've gained some insights from this video. If you have, please leave a like and subscribe to the channel. Thanks for watching.